Hi, this is Matthew Cratter from Trader University, and today I want to talk about Warren Buffett's quote about stocks being ridiculously cheap. If you're interested in learning how to invest, how to trade, how to make money in bull and bear markets, as well as learning how the economy actually works, not how it works in textbooks, but how it works in the real world, be sure to hit that subscribe button. So this is a quote actually from May of 2019. Warren Buffett saying that stocks are ridiculously cheap if interest rates stay at this level. Now, back when he said this, the 30-year bond, the 30-year Treasury in the U.S. was about 3%. So what he was basically saying is if interest rates stay at what he considered very low levels there, then the stock market was undervalued. What he was saying at the time is he expected interest rates to mean revert higher, to move much higher for various reasons. They've historically been much higher than this as well. So let's look at a chart of the S&P 500. This is the SPY. And when Buffett gave this interview of May 2019, approximately a year ago, the SPY was at 292. Today it's at about 302. It's obviously been volatile this year. If Buffett was right about that, not only are stocks ridiculously cheap now, but they're even cheaper simply because the 30-year Treasury has moved from 3%, where it was last May, all the way down to, I want to say, about 1.5%, maybe 1.6%. So what this means is that maybe stocks should be at twice the value, at least twice the value where they were when Buffett did this quote. So instead of being at 302, maybe we should be at, call it 500 or 600. This would translate to 5,000 or 6,000 on the S&P 500. Now, this is a big assumption to make. You saw my video from 2 days ago, which I'll link to today. I'll link to in the notes about how I think we're due for a really big stock market rally in the coming 12 months. But let's just first examine this idea and see what Buffett is talking about, because according to his own words, the stock market should be trading a lot higher if we think interest rates are going to stay low. And I'm going to give you the reasons why I think interest rates are going to stay low. So when he did this quote, the 30-year was at 3%, it's now at 1.6%. Fed funds was at, call it 2.2% to 2.5%. This is the rate that the Federal Reserve sets. So this has obviously fallen quite a bit as well. It's basically at zero right now. Now, why do I think interest rates will stay low for a very, very long period of time? Well, it's very simple. The math is very simple. If we're looking at U.S. government spending, the U.S. government currently is bringing in about $3.2 trillion in tax revenue. Obviously, this is highly dependent on the stock market's performance as well. Currently spending about $6.3 trillion, with rumblings of having to spend a lot more to stimulate the economy, especially if we get a second wave of COVID. Now, what's interesting is if you look at the largest budget items, which are the entitlement programs, which I've talked about in previous videos, Medicare, Medicaid, Social Security, spending on defense, preparations for war or defense, and also interest on the debt. If you add up just these four programs, which are the biggest programs, they are already much higher than federal tax revenue. So what does this mean when you're spending more than you're bringing in? It means you need to borrow money. The way the U.S. borrows money is it sells government bonds. It sells treasuries. The U.S. Treasury issues these pieces of paper, or digital pieces of paper, collects cash from them, and sends it off to Congress. Now, the higher your budget deficits, in other words, the higher that shortfall in spending versus tax revenues, the more treasuries you need to sell. This is one reason that the U.S. national debt, just in terms of treasuries, is up to $26 trillion, not to mention all the unfunded liabilities we have. Call it $20 trillion for Social Security, $32 trillion for Medicare, et cetera, et cetera. This has unfunded liabilities at $148 trillion. Whatever you think the actual numbers are, they're obviously very, very high. So if you're going to sell a lot of treasuries, the U.S. government needs to borrow a lot of money. It needs to sell a lot of treasuries. To whom are you going to sell them? Well, historically, we have been selling our treasuries to foreign investors, international investors. In the wake of Bretton Woods, actually when we left the gold standard in 1971, after the Nixon shock, a lot of European countries began to buy U.S. treasuries after that and sort of store them in their vaults as a form of reserves, sort of equivalent to gold. Eventually, the Europeans just didn't have enough money to buy all of our treasuries. This is one reason that China was brought into the WTO in 2001. And then you had this sort of golden period where we would buy a lot of stuff made in China. All the supply chains moved overseas, and they would take the dollars from all the stuff that they were exporting, and they would recycle it back into U.S. Treasuries. So they would give us stuff. We would give them dollars. They would use those dollars to buy U.S. Treasuries, which kept interest rates low, allowed the housing boom of the early 2000s, allowed Americans to get cheap consumer loans and buy boats and buy cars and buy RVs, etc., all courtesy of China and to a lesser extent Japan as well. But then something funny happened around 2013. This really began to level off. And this coincided with a point at which the deficits, the budget deficits began to really rise. So we had a problem. We were running out of buyers of U.S. Treasuries. At some point in 2015, 2016, hedge funds really began to step up and buy these. Also, U.S. banks, J.P. Morgan, Bank of America, Goldman Sachs, the big banks were buying U.S. Treasuries. So government selling Treasuries, you need a buyer. It really shifted from foreign buyers, international buyers, to the big banks and to hedge funds. Now, what happened is the budget deficits continued to rise. We kept spending more and more money. And as a result, we ran out of buyers of our treasuries. And this is what happened in the third quarter of 2019. We talked about it a lot when it was happening. What this basically meant is we could no longer sell our paper, sell our treasuries to China. And the bank balance sheets, the U.S. bank balance sheets, got too full. They could no longer hold any more treasuries. They were down to their, they have to maintain sort of a buffer, a cash buffer level. They couldn't buy any more treasuries. Even hedge funds got stuffed with treasuries. And the way hedge funds buy treasuries, they usually do it as part of complex trades, and they borrow in order to buy them. They borrow using repo. So this is what the whole repo crisis was about. Basically, it meant that there were too many treasuries being sold, and the hedge funds and the U.S. banks could no longer absorb them. China and Russia weren't interested in buying anymore or increasing their holdings. China and Russia, in fact, have been buying quite a bit of gold over the last few years. I think that's been the smart money trade. So what happened in the third quarter of 2019? Repo rates, which are these short-term rates that banks, basically a bank will lend a treasury to another bank, and maybe overnight, and at some interest rate, some annualized interest rate, and they'll get cash. And this is really a backbone of our crazy fiat system. But repo rates in the third quarter spiked to about 10%. These are short-term rates. This is back when the Fed is at 1 or 2% at Fed funds. But what does it mean when repo rates go to 10%? Well, what it means is that the 10-year note, the U.S. Treasury 10-year note, has to adjust much higher. It would have to be trading at 12% or so. And Buffett's 3% 30-year bonds here would really need to be trading at maybe 15 or 16%. Now, what does this mean? This means that all of a sudden your mortgage, your 30-year mortgage, if you need to get a new one, spikes to 14%. Your auto loan spikes to 18%. Obviously, we can never have a situation like this. It would completely tank the economy. It would make the stock market go down. The housing market would crash. If you have mortgage rates going from 3 or 4% or 5% all the way up to 14%, you could get housing prices going down by 50 or 60%. It would cause another Great Depression. So who is left to buy? Foreign buyers can't buy. Banks can't buy. Hedge funds can't buy. You and I are not buying treasuries because they yield 1 or 2%, which is just ridiculous. It's basically the government stealing your money because they yield less than the inflation rate, even less than the official inflation rate of 2%. So who is the sucker at the table? Who's the buyer of last resort? And maybe they're not suckers. Maybe they're just, perhaps they're just evil. Federal Reserve steps in and starts buying treasuries. They print money and they buy treasuries, and they temporarily halt this repo crisis. This article is from December 30th, 2019. Basically, the federal government, the U.S. Treasury, needed to keep selling treasuries. There were no buyers left, and so the Fed printed up some new money and started buying this supply of new treasuries. Now, this was all before COVID hit. This was all before the crazy 2020 year we've been having. But what this meant was that even if times hadn't gotten crazy, as long as we were having these giant budget deficits. So I guess the number right here, federal budget deficit 3.1 trillion. The U.S. Treasury needs to issue at least 3.1 trillion in new treasuries every year, in addition to rolling over their existing treasury holdings. So even before COVID, you had the Fed buying simply because they needed to buy treasuries. Otherwise, interest rates would spike and destroy the stock market and destroy the real estate market. The U.S. economy has become increasingly financialized. It's not a manufacturing economy anymore. It's people sitting at home day trading. It's hedge funds. It's big banks and central bankers. Unfortunately, this is the reality. I hope it changes. I hope supply chains come back home to a certain extent and we can sort of start up high-tech manufacturing again. But the fact remains is that everything is geared to the stock market. Everything is geared to the basically geared off of interest rates. So the Fed basically stepped in and committed to keep interest rates low. If the U.S. Congress, the U.S. government's going to keep spending so much money, they're going to have to keep selling debt. There are no buyers left, and so the Fed needs to step in. Now, in the wake of COVID, this is being called yield curve control. This is the new term for it, YCC. Here's a paper from new paper from June 5th, 2020 from the Brookings Institute. Obviously, a very powerful think tank that has a lot of influence on government policy. And the people who work at the Brookings Institute go back and forth between government jobs and university jobs and think tank jobs. These are the elites who control are the puppet masters, so to say. And so basically, they've begun to institute a policy of yield curve control. What does this mean? It means it's a policy to keep long-term interest rates low, to keep them pinned very low, simply because we can no longer cut Fed funds rates. There are a lot of problems with taking interest rates negative, short-term interest rates. No one likes to earn a minus 2% in their bank account. If you have $100 after 1 year, you only have $98 left. So the easier way for the government to steal from us and for the bankers to steal from us is to have the Fed print up some new money and buy treasuries in order to keep interest rates low. This is becoming official policy. We've seen it over a long period of time. If you look even at a long-term chart of the 30-year Treasury, it is basically a series of lower highs and lower lows. There's a one-way trend, possibly headed to zero or headed to negative as it is in a few countries. But this is the term you'll be hearing, yield curve control. It sounds like a really nice thing, but it's actually printing up new money, buying treasuries, keeping long-term interest rates low. So here's the dilemma, and this is what Mr. Buffett needs to understand. And perhaps he would have been buying stocks in March if he had understood this. Basically, as long as the government runs deficits, it's going to need to dump treasuries. There needs to be a buyer of that. And so the Fed is going to need to continue to print money to buy these treasuries. What this means is that interest rates are going to stay low for a very long period of time. And not only is the 30-year bond at 3% now, as we saw, it's really much lower. It's about 1.60%. The government, especially with all the job losses in the wake of COVID and all the instability, the riots, the protests, the marches, the political division, the November election coming up in the U.S., there's a lot of social unrest. We cannot have high interest rates in a period like this. And we certainly cannot have high interest rates when the U.S. government is going to need to be borrowing from here to infinity. As the boomers retire, as the Xers retire even longer, these Social Security promises will need to be paid. You cannot cut the defense budget. You cannot cut defense spending when you have the world reserve currency. You cannot cut entitlement spending, what's been promised to retirees. You can't default on your debt, especially if you're a sovereign like the U.S. is, if you're the most powerful country in the world. And why would you default on your debt when you can actually steal from people and pretend you're making it whole by just printing money? So if we look at what's been happening, this is a chart of U.S. Treasuries that have been bought by the Fed using newly printed money. And you can see it's really been moving up since the 2008, the Great Financial Crisis. There was an attempt in 2018 to slowly shrink the balance sheet and let some of these treasuries roll off, but interest rates spiked, the stock market sold off, and then in the wake of COVID, this is really a one-way chart. And the more stimulus that we do, if we get a second wave of the virus, if we have more social unrest, we're going to need to send checks to everyone, send free money to everyone. We're going to need to borrow more money to do that, which means more treasuries are going to need to be sold by one arm of the U.S. government and then bought by the central bank using newly printed money. So again, this is a chart that's just going up. This is going to go up to 10 trillion. It's probably going to go up to 20 trillion, all using newly printed money. What this means is that long-term interest rates, this is what yield curve control means, is that long-term interest rates are going to stay low for a very long period of time, simply because the central bank, the Federal Reserve, can pin them there, which means that stocks, according to Warren Buffett's own criteria, are ridiculously cheap. We are going to see a melt up in stocks. We're going to see a melt up in gold, and especially a melt up in Bitcoin as the money supply is increased, as the Fed is forced to print a lot more money. Now, this has been a trend that's been accelerating over many years. We've seen that the S&P has been trading at increasingly higher levels. This is kind of a funny chart because it says when it's in the pink part up here that stocks are in an extreme bubble, but they've actually been up there for a very long period of time. You can ignore really big spikes like this. This is when earnings went way down during the great financial crisis, 2008 to 2009, etc. But if we look at a chart, this is a little clearer on this chart, we can see that the trailing 12-month PE for the S&P 500 used to really be below 20 for extended periods of time. That's where it spent most of its time. And when it spiked above that 20 PE, it was usually a good time to short. And now, for the past, really since the late 90s, we've spent a lot more time above this line. PEs have moved to a permanently higher level, simply because PEs are related to interest rates. If you take the inverse of a PE, you get something called the earnings yield, earnings divided by the price of the stock or the index. This is expressed as a percentage. And if interest rates are lower, that means the earnings yield is also going to be lower. And when you have a lower earnings yield, that means the inverse of it is the PE. You can have a much higher PE. And so I would expect PEs to continue to move higher, simply because the Fed has to pin interest rates at a very low level. Now, if you're a value investor, if you've been thinking in sort of Buffett terms, traditional Buffett terms for the past 10 or 20 years, you've had a rough time. Value investing doesn't work anymore. We're in a new regime of money printing. We're in a regime where you have to understand gold, you have to understand Bitcoin, you have to understand momentum stocks. So if you found this helpful, I'd encourage you to check out my other YouTube videos, obviously all free. And if you want to take it to a really deeper level, check out my online courses, Learn to Day Trade, Learn to Trade Stocks. I have courses on crypto and Bitcoin, trading options, momentum stocks. I actually list my favorite momentum stocks here weekly, how to make money with IPOs. This is how to make money in the stock market going forward. One can also just buy an index fund. I think that'll do very well. One could just buy gold. I think Bitcoin is probably the best investment out there right now. So whether you're interested in investing or trading, or you want to learn a little bit more about how to read financial statements, how to invest in dividend stocks, you can follow along with my dividend investing. Click on the links in the description notes below. It'll take you to this page, and you can click on any of these boxes, and it'll give you the list of lectures for that particular topic. Now, if you're interested, you can scroll down and click at the bottom where it says Get It Now, which will take you to the checkout page. I want to give you a special coupon code. Normally, you get access to all 15 courses for just $125 for 30 days access. But because we're still in a recession, I want to give you a coupon code, which is YT99, as in YouTube 99. You click that, it'll take $26 off the price. You get access to everything on the website for just $99 for 30 days access. You can watch all the courses, take notes, write down my list of momentum stocks, and cancel before 30 days. You won't be charged again, and there are no long-term contracts or anything like that. Hope you guys found this video helpful. If you did, hit that subscribe and like button, and let me know your questions and comments in the comment section below. Hope you have a great weekend, and I'll see you in the next video.